Hi, everybody. Good afternoon. This is Gina Campanella from Campanella Law Office, welcoming you to our webinar, You Don't Want to Work Forever. And this is a look at small business retirement options that I am so happy to bring to you with my colleague and my good friend, David Bailin, who is a financial advisor with Personal Wealth Strategies here in New Jersey. David Bailin actually founded Personal Wealth Strategies in 1996. And his goal was to help successful individuals and their families accumulate and preserve wealth. The focus of his financial practice has been providing advice to clients and assisting them in making smart decisions about their money. David is a student of financial research, and his investment strategies are grounded in the Nobel Prize-winning principles of modern portfolio theory, which David can explain to you, and that's why he is here as our expert, not me. David is a graduate of Lehigh University in Bethlehem, Pennsylvania, and during his career, he has earned the accredited investment fiduciary, chartered financial consultant, and chartered life underwriter designations. He's also earned certification in long-term care, and David is a member of the $1 Million Roundtable and the Top of the Table, representing financial professionals around the world. David and his lovely wife, Nancy, who's also a good friend, have been married for 33 years. They live in Chesterfield, New Jersey, and their son Arthur is a third-year law student at the University of Georgia, even though I've told David, tell him not to do it. Nancy are founding members of the Brother Kevin and Delanisi FSC Forum Fund to support the speech and debate program of LaSalle College High School in Windmore, Pennsylvania. So now that you know a little bit more about David, I'm sure you can all see why David and I, those of you who know me, have similar theories about how to approach business, how to approach small business, and how to approach our small business clients. So I will turn it over to David, and he can speak with you a bit more about the topic of the afternoon. Go ahead, David.
Thank you very much, Gina. It's a pleasure to be here and a pleasure to talk on this, what I think is actually a pretty important topic, particularly for small business owners. One thing I have to correct the record because my son would be very upset. I didn't realize I have to update my bio. Arthur is now a law school graduate and a member of the Georgia Bar, where he works as a public defender. So he jumped in with both feet. But to our topic of the day, Personal Wealth Strategies, our firm, are founded with the idea that we wanted to create a company that was going to be independent of the large financial companies. So when I started my career, I worked for Prudential, a pretty good sized company in New Jersey. But much of the advice that we were giving was, I'll use the word biased, although that's probably too strong a word, but biased towards Prudential and the company's products. And in founding Personal Wealth Strategies, we wanted a company that was going to be independent, who would work for our clients and be able to provide objective advice. So part of that objective advice is to be able to speak and educate our clients so that they can make informed decisions. So in looking at the topic today, let's start with what are the advantages of establishing a retirement plan? Well, this may seem obvious, but the first thing I'm going to list, and I quite frankly, preparing for the presentation today, I moved this to the top of the list. It's usually number 2 or 3, but in today's competitive employee market, attracting and retaining quality employees is got to be in the top of everybody's mind. It's particularly challenging in a state like New Jersey, where we still have a very high unemployment rate, one of the highest in the country. And it's a competitive market. If anyone's looking to hire anybody, as we are right now, there aren't as many quality candidates looking, and certainly they're going to want to know about the benefits that you have to offer. Having the ability to deduct contributions, both as an employee and as an employer. So you'll hear me talk a little bit today about the idea that people wear 2 hats. One, as the owner of a business, but also as the employee. So when you're making contributions into a retirement plan, both the employee side and the employer side are going to be tax deductible in what we call a traditional plan, which I'll touch on a little bit later. So retirement plans are going to have 3 different types of taxation. There's the issue about when you put your money in, is it going to be tax deductible? But all retirement plans have the common element that they're going to have tax deferred growth. So once the money goes into the plan, it's going to grow, without you having to pay taxes on that growth until sometime in the future. So if you deposit $1,000 into a retirement plan and it grows to 2, to 3, to 4, you don't have to pay tax until later on. And if you set up a Roth design, Roth designs would allow you to take money out at retirement on a tax-free basis. Some types of retirement plans will offer liquidity through a loan provision. So in the last, well, I guess about last 2 years since COVID has been out, a number of clients have had to go into the retirement plans to take loans out to replace lost earnings. Now, it's one of the ways that people have accessed it, but some people will access their retirement plan to purchase a copier for the office or to put a down payment on a new office. So having that liquidity is an important feature. And also their retirement plans can be flexible in terms of how much you put into them. So some plans are going to be going to have locked in levels of contribution, which we'll talk about in a moment. And some will give you that flexibility to decide each year how much you want to contribute. Now, as I mentioned a moment ago, there's two different types of designs. One is what's called traditional, and one is what's called Roth. Now, you'll hear these expressions used quite commonly in the area of individual retirement accounts or IRAs, but they can also pertain to a company-sponsored retirement plan. The difference between a traditional and a Roth IRA is how the contributions are treated for tax purposes and how the distributions are treated. In the case of a traditional plan, the contributions are tax deductible both for the participant and the employer. As I mentioned earlier, you have that tax deferred growth, but in the back end, when you take the money out, it's subject to ordinary income taxes. In the case of a Roth IRA, or in the case of a Roth retirement plan, in a Roth retirement plan, the contributions you're making are going to be after tax. You still have the same tax deferred growth, but when you take your distributions, in most cases, those distributions are going to be tax-free. So the difference between traditional and Roth, traditional tax deductible up front, Roth is after tax. Traditional is taxable at retirement, Roth is tax-free at retirement. So an easy way to remember which is the better plan for you is to think about when will you be in the higher tax bracket. You want the tax break to occur when you're in a higher tax bracket. So for someone who's just starting out, you're typically going to be looking at a Roth because you're going to be in a higher tax bracket in retirement than you are right now. That's something you probably haven't heard a lot of because most literature on the topic of retirement planning is always assuming that you're going to be in a lower tax bracket in retirement. I will tell you, having done this job for a number of years, our successful clients are paying quite a lot in taxes in retirement. So the Roth is definitely a consideration for them. And this is also another good time to think about Roth is if you're starting out a business, because when you're starting out a business, you're going to have a lot of deductions up front for the startup cost of the business. And in the first year or two, you may have very little income. We oftentimes will see a business, depending on the industry, have negative income in the first year, and that would be an excellent time to put money into a Roth. So when it comes to the point of choosing which type of retirement plan you're going to use, there's a couple questions that we always suggest that people ask. And sometimes these are overlooked, but number one is, what do you want to accomplish with the retirement plan? And number two, as the business owner, how much flexibility do you need? Oftentimes, and we see this with our healthcare planning for clients as well, what do you want to accomplish? People look at me like, well, of course, what do you think? We have to offer health insurance to all our employees, don't we? Well, there's more to it than that. There's the question of, am I looking to maximize the benefit that I receive as the owner? Oftentimes with retirement plans, that's what's driving the decision. The owner is saying, I want to get a tax deduction for my own personal benefit. But oftentimes, retirement plans can be used as a way of compensating existing employees. If you currently don't offer a retirement benefit, and the employee in a tight labor market, you're thinking they may be talking to someone down the street who's going to offer them $1 an hour more, offering a retirement plan may be something that's not very common. So if you talk about an industry like restaurants, okay, most restaurants don't think to offer their employees retirement benefits or healthcare benefits. But by differentiating yourself and offering those benefits, it will certainly help to retain those employees that you already have. How many employees you have is also a factor. The larger the employee base, the more you're going to look to certain types of retirement plans. What's your budget for the plan? Right, so there's going to be, with some retirement plans, a pretty hefty contribution made by the employer, where in others, there may be practically none. Do you want the plan to be an employee or employer funded? Are you willing to pay for plan administration? Because as you can probably guess, the more complex the plan is, the more likely you are to have to pay for an administrator. And if you're willing to pay for that administrator, that may lead to larger contributions. And then ultimately, do you need flexibility in your contributions? That's important for companies where from year to year, profitability may vary. So when we get into the types of retirement plans, let's first talk about an individual retirement account, or IRAs. So when I do these presentations talking about employer-sponsored plans, a lot of times we overlook IRAs because, quite frankly, they're not an employer-sponsored plan, they're individual. But we can dress up IRAs to make them look like an employer-sponsored plan by having the employer either offer payroll deduction for the contributions, or perhaps the employer deciding to help make contributions to that IRA. Just as an aside, one of the very effective ways we found to reward employees and to retain employees is use the same concept for college savings. By offering a tax-deductible college savings plans for people, for your employees, and perhaps the employer putting a little bit of money in, maybe you want to do as a matching contribution, you're going to have an employee saying, my company is helping me save for my son or daughter's college education. And I'll bet you there's not another company that person's ever going to interview that's willing to match that benefit. Doesn't have to be very expensive, but if you put in, I don't know, say $100 a month to their son or daughter's college education, you could be helping an employee save for their most important goal at a very low cost to you. But back to the retirement plans. Setting up an individual retirement plan would allow an employee to save money with your assistance and get them on the right track. So an IRA is not really a true employer-sponsored plan, but it can be used to help employees save for retirement, letting each one of them set up a plan at their institution of their choice, whether it be a bank or a mutual fund company. It will allow them to contribute up to $6,000 per year. And if the participant is over the age of 50, and this is going to be, you're going to hear this as a common theme through retirement planning. If they're over the age of 50, there's a catch-up contribution of $1,000. Now, we're at a point in time in the calendar year where we can also tell you what the rules will be for 2022. In the case of IRAs, there's not going to be a change on the limits, but you'll see later on as we get into some of the other planning, you'll see that limits have been increased. IRAs are completely flexible, and we don't need to make a contribution every year, nor do we have to have a set formula. One of the other advantages of IRAs that I failed to mention earlier is because they're not a company-sponsored plan, it means that you can discriminate between employees. And here the word discriminate is a favorable thing. It means that you can choose which employees get the plan, which employees don't. You can have different matching formulas. You can do anything you want because you're just doing this out of the kindness of your heart as part of their compensation and not as a qualified retirement plan. Now, we'll flip the page now into qualified retirement plans. And these are company-sponsored plans that meet the IRS guideline of Section 401A, which basically means they're company-sponsored. Now, when I talk about company-sponsored plans, all these plans are governed by rules set by the IRS, and it does get quite complicated. I believe that in all the planning that we do for clients, that pension plans or qualified retirement plans are the ones that you're most likely to make mistakes on. right? So there's a lot of different types of pension plans available, qualified retirement plans. Those terms are somewhat interchangeable. Everything from SEPs, simple IRAs, 401ks, 403bs, defined benefit plans. It begins to sound like a lot of gobbledygook, but basically they all have different sets of rules. So let's take a look at each one of these. All qualified retirement plans can fall into one of two categories. One is a defined contribution plan, which is the most common type of plan in today's market. The other is a defined benefit. A defined contribution plan is one where the employees can choose how much to contribute each year. But in doing so, there's no guarantee of how much it's going to be worth down the road. Most common examples of defined contribution plans are simple IRAs, 401ks, and 403b plans. Okay, and if you're familiar how 401ks work, you put your money in, and down the road, you just hope you have enough for retirement. In a defined benefit plan, and these are typically called pension plans, contributions are made by the employer only, no employee contribution, employer only, and the amount the employer has to put in is based on a formula that determines how big the benefit will be at retirement. Thus the name, defined benefit. Teachers, state workers typically have these types of pension plans. So if you're familiar with the state pension plan here in New Jersey, it's based upon the number of years that you've worked times your final average salary. So for example, someone who works 30 years and retires from the state will typically receive about 60% of their final average salary. So the 401k or the defined contribution model, you put in, the employee puts in as much or as little as they want. In the defined benefit plan, the employer puts in based upon some formula of what the employee will receive at retirement. So now I'm going to touch on each one of these plans. I'll go through this relatively quickly, but the slides have the details on them. And we can, anybody who's interested, I can send them more detailed information that they can sit and look at on their own. I just don't want to bore you with details of plans one after another. So the first one I'm going to do, and by the way, I'm working these through from the more basic onto the more complex. So we start with the IRA, where you can put in up to $6,000 per year. Now we're going to go into what's called a simple IRA, or simplified employee pension, sorry, getting ahead of myself, okay, or a SEP plan. In a SEP plan, this is all employer contributions, and the employer can contribute up to 25% of compensation. Okay, the employees do not contribute. Quite frankly, we don't see a lot of SEP plans anymore because back a decade ago, employees could contribute, and this became like a mini 401k. But now that employees cannot contribute to SEP plans, the only time we ever see it is in a 1 or 2 person company. And quite frankly, there are better options available than the SEP plan. You do have the flexibility in the SEP plan of how much you contribute every year. So there are years you could choose to make no contribution, where other years you can choose to put the maximum. The next type of plan we'll talk about is a simple IRA, and these are more common. They're only available for companies that have 100 employees or less. So you don't see them in the mainstream press quite as much because the larger companies will not offer it. But a simple IRA is what I'd like to refer to as a mini 401k. And in a simple IRA, each employee can choose as much or as little as they want to contribute, up to a maximum of $13,500 per year. And that's the 2021 number. For anybody over age 50, they have that $3,000 catch-up provision. Next year, the $13,500 will go to $14,000. But the employee chooses how much money to put in, and then the employer is going to contribute into this using one of 2 formulas. Either going to match dollar for dollar what the employee contributes up to 3%, or they're going to put in 2% for every employee, regardless of whether they put any money in at all. Which option is right for you is going to be dependent on the demographic or the makeup of your company and how many employees are contributing. Most employers are going to look at this and say, how do I get away with putting a simple IRA plan in place that's going to allow me personally to put in $13,500 on a tax deductible basis and get a contribution from the employer on top of that without costing me an arm and a leg for my employees. Next, we move into the 401k. Now, 401k plans can be used for larger employers and are used by larger employers, but they can also be very effective in the small company market as well. 401k plans, compared to that simple IRA, is going to allow for larger contributions. It does allow you to set up either traditional or Roth. So the first two things that we talked about, SEP and simple IRAs, have to be traditional, meaning pre-tax contributions going in. The 401k plan now adds that Roth contribution as an option. The contribution levels here, you'll see instead of the $13,500 in the simple plan, now goes up to $19,500. And for those over age 50, that catch-up goes from $3,000 up to $6,500 now. So you can see where if I'm working as an employee, and I'm over age 50, I could be putting in $26,000 into a 401k this year. If I am over age 50, that number would be even higher. I'm sorry, if I was under age 50, do it the right way. If I'm under age 50, it's 19.5. If I'm over age 50, it would be 26,000. So it's a much higher limit. Now, that's just the employee portion. The employer can choose to make no contribution. The employer can choose to put a matching contribution in, or the employer can put a profit sharing contribution in. The match is typically spoken as a percentage of the contribution the employee has contributed. Oftentimes you're talking about a 4% dollar for dollar match, or you might hear 50% of the first 6% that the employee contributes. But the profit sharing would say that the employee contributes what they contribute, and at the end of the year, the employer is going to decide, we've had a good year, we've had a bad year, I'm going to contribute 5% of what everyone else, what everyone is earning. The name profit sharing is a bit of a misnomer though, because the company doesn't actually have to have a profitable year. You could have a year where you've lost revenue and still make contributions into a 401k. Conversely, you could have a very profitable year and choose not to share that with the employees. The last item on this slide is kind of important, and that is there is a thing called a solo 401k, which means that the company employs only the owner and maybe a spouse on a full-time basis. They can have no other eligible employees, and in a solo 401k, you can throw away all the administration. So it works very simply and at a very low cost. Now we move into the area of defined benefit. Defined benefit plans are more complicated because you need to hire an actuary to do the formula and to calculate the formula and calculate the contribution you need to make. Defined benefit plans are typically set up, as I mentioned before, by municipal organizations because they've been collectively bargained with the union, or they're set up by small companies who are looking to make large contributions into the retirement plan. In that case, in the case of a small company, it's typically driven by the owner who's looking to maximize the amount that they contribute. So for example, we have a client that's a small law firm, and the attorney there who is close to retirement is looking to maximize the amount that he's able to contribute. And currently he's contributing about $170,000 a year on a tax deductible basis into a defined benefit plan. Now, it's fairly expensive for his one employee, but you can imagine getting a tax deduction on $170,000 generates enough savings that it makes it worthwhile for him to do this. There is a limit to how much you can use in the formula. So remember I said that this is going to be based upon the number of years worked typically, and final average salary, the defined benefit plan in 2021 can only generate a benefit to a retiree of $230,000 a year or less. Still, I think most would agree that if you're getting $230,000 in a pension payment each year, you're doing all right. All right, so that's the different types of pensions. I've left out a couple, but I wanted to make sure we hit the different ideas. So now let's talk about the employer responsibilities. I'm going to introduce you to a word that you probably have heard before, which is fiduciary. And when you work as a fiduciary, it means that you're required by law to act in the best interest of the people you're supporting. In this case, as an employer, you have to act in the best interest of your employees. So what are the responsibilities of the employer on a non-fiduciary basis where you don't have to act in your employee's best interest? Obviously, you still have to do some things that are suitable for your employees. You can't endanger your employees, but you don't necessarily legally have to act always in their best interest. Well, when it comes to retirement plans, your non-fiduciary responsibility is that you're allowed to establish a plan. And you'll notice a lot of white space on this page. And that's because when I turn the page, you'll see there's lots of things that you have a fiduciary responsibility in. And this can be the part that scares people off from retirement plans. But number one, you have to select a fund lineup of what's considered to be prudent investments. And there's a lot of litigation out there in very big pension plans right now over what's a prudent investment. We see a lot of times, particularly in small businesses, where the owner thinks of this as their personal retirement account, and they'll look to use their company retirement plan as a way to get into investments that they personally like. We'll see people say, I want to buy Tesla. Can I buy Tesla through my retirement account? Today we're hearing a lot about cryptocurrency. Can I buy cryptocurrency through my account? Well, if you can do it, it means so can all your employees. And if an employee were to put money in, say, Bitcoin, and tomorrow Bitcoin fell by 20%, the employee can say, why would my employer ever expose me to such an investment? That doesn't seem very prudent to me. And quite frankly, if that employee took action, the employer would probably be held liable because it's not considered to be prudent. It could be a good investment, but it's not considered to be prudent because your employees aren't well enough educated to make that type of determination. From an administrative standpoint, you have to run from a compliant plan document. You have to be careful about the way you operate the plan. There are disclosures that have to be made to the employees. There's testing that needs to be done. Bottom line is there's a lot of things you can get tripped up on in running a retirement plan. If these things scare you or turn you off, then you're going to want to look towards one of those plans I spoke about in the beginning, where they're designed to be more simple. Paying out reasonable expenses for the plan. One of the things that's really critical is you need to be, because you're taking on the responsibility of fiduciary, you need to review your plan. We suggest once every 3 years, to see if the plan charges are competitive with what else is out in the marketplace. You have to make sure you deposit your employee contributions on a timely basis. Small businesses get tripped up on this one because they'll run payroll, and it'll be a busy time of year, so they won't have time to deposit the money into the retirement account that they deducted from their employees' pay. And time goes on, and once you cross the period of time that's considered to be reasonable, you have to pay a penalty for holding the employees' monies for too long a period of time. For some pension plans, you have to also maintain a fidelity bond, which basically ensures that you're not going to steal the money from the employees. And you have to select and monitor the service providers that you have. On here, and I think Gina will back me up, when it comes to compliance issues, document, document, document. If you don't write it down, as far as an auditor or a regulator is concerned, it just didn't happen. There are 3 types of service providers that you're going to be working with. One is an investment manager, and that's the work that I do. But an investment manager oftentimes is the person who's going to introduce you to the idea of the retirement plan. They oftentimes will be the quarterback. They will many times be the ones who introduce you to that record keeper and third-party administrator. But that's just the way it happens often. It doesn't have to be that way. And sometimes you might know a third-party administrator, and they may be the ones who suggest to you that you set up a retirement plan. But what I do suggest when you're working with an investment manager is that if you don't know the investment manager beforehand, look for somebody who has accreditation in working with retirement plans. So when Gina gave my introduction, she mentioned I'm an accredited investment fiduciary. That is one of the accreditations that you can earn in retirement planning. Other accreditations that are appropriate in the investment world, like certified financial planners and chartered financial consultants, means that they're trained generally in the world of investments, but not necessarily in retirement planning. Doesn't make them unsuitable or a bad fit. It just means that's not their specialty. The record keeper is the company who's going to establish the website, create the statements. As the name would imply, they keep the records. And the third-party administrator can be bundled with the record keeper, so it could be one company. And in small companies, small retirement plans oftentimes are bundled. But when you need more customization, you may hire a separate third-party administrator to design the plan. Finally, just to mention about personal wealth strategies, when we're working with clients, what we're looking to do is to integrate the retirement plan as part of the entire benefit package. As I mentioned earlier, as an employer, we like our companies to think about how they're compensating employees, and compensation is not just salary. Employees will leave for salary if they're getting a bigger salary elsewhere. But companies, particularly again with small companies, typically cannot match the benefits that you're going to be offering. So the benefit is what retains employees, while the salary is what attracts employees. The final thing I'll mention is that on the bottom here, I put down that all non-insurance services are performed on a fiduciary basis in our firm, which means that we are always looking out for our clients' best interest. You can always ask your investment people if they're acting as a fiduciary. In fact, by law now, they must disclose this to you up front in writing, whether they're going to be acting in your best interest or just simply selling you product that is suitable for you. So we're obviously going to always suggest that you're dealing with someone who's in acting in your best interest, holds them to a higher standard. And with that, I'm going to turn it over to see if we have any questions.
All right, thank you so much, David. Now, if anybody has any questions, there is a chat box and there is also a question box. Feel free to go ahead and type your questions in there, and I will go ahead and pass them on. And have a couple. First, okay, so this is an interesting one, and this is actually something I had. Oh, I hear some background noise. The question is, you didn't mention 403B plans. Where do they fit in?
Okay, so I did not mention 403B plans because 403B plans are set up by nonprofits and educational organizations. So unless one of the attendees is a nonprofit or an educational organization, they're not going to look to be setting up a 403B plan. However, many of the attendees may have worked in a previous life, either through their educational experience or perhaps a previous job, with a company that did offer 403B plans. But in general, 403B plans look very much like a 401k plan, except for the employer does not typically put a matching contribution in. So 401k plans typically have matching contributions because of some of the compliance. In order for the employers to get the maximum benefit and in order to get employees to participate, they typically want to put a matching contribution in there. But in a 403B plan, because everybody is individualized, there's typically no contribution made by the employer. It may run in parallel with another type of plan, but a 403B plan oftentimes does not have the match in it directly. Good question.
Okay. Now the next question I have here is this. I understand there is a tax credit to offset the cost of starting a new plan. Can you talk about that a little bit?
Okay, thank you. Yeah, I anticipated somebody might ask that question. So I do have a slide here. Okay, so there is a tax credit for a company that has not yet had a retirement plan in place. You will get a credit. Now, a credit, for those who aren't familiar, is better than a tax deduction. A tax deduction means if I have $1,000 of income and I have a $500 tax deduction, then I will deduct the 500 from the 1,000 and I still have to pay tax on the 500. If you have a tax credit of 500, if I have $1,000 of earnings, and let's say I'm in a 20% tax bracket, that means I owe $200 in taxes. I then can apply my $500 to the $200, and in fact, I'm going to get a $300 refund in that case. A credit is like a, I don't know, gift certificate, if you will, issued by the IRS. But if you start up a new plan, the law now allows you a credit of 50% of your startup cost to the greater of $500 or the lesser of 250 times the number of non-highly compensated employees who participate in the plan, up to a max of $5,000. So that means if you choose to go the route of a 401k plan and have to hire a third-party administrator, you're going to be able to get a credit for a good portion of the amount of money that you spend to hire that administrator. So it's a way that the Congress has tried to entice businesses to get started with retirement planning.
Okay, we have another really good one that came in. This question is, you said depositing an employee's contribution must be done in a timely manner. What about the employer's contribution if there's a matching program? Are there specific time frames for that?
They are, but they're far more liberal. So from an employer standpoint, you have until the tax filing date with extensions. So potentially you could be, depending on your corporate status, could be up till September or October 15th of the following year. As a matter of practice, a lot of small businesses find it easier to match the contribution to match the contribution as it's coming in, because that way when you enter payroll, if you're entering the employee's contribution, you can put your contribution right next to it. But again, I caution you, because if you decide to defer your contribution, you are legally obligated, and if you don't make that payment on time, there are penalties. So you just want to make sure you don't forget about it.
Okay, and we have another question. What is the best option for someone who's just starting out and is the only employee?
Okay, so going back to the questions that we spoke about earlier, let's see if I can get back there quickly. You want to really think about why you're starting the plan, even when it's just yourself. Let's see. Here we go. So what are you trying to do? And again, if it's just yourself, it's typically you're going to be maximizing your own benefit, but then you come down to how much do I want to contribute? So if you say I'm going to contribute $6,000 a year or less, you're probably fine just setting up an individual retirement account and not going the route of all the complications I've been speaking about. However, if you're married and your spouse has a retirement plan at work, you may not qualify for the deductibility of an IRA, which may force you into doing a company-sponsored plan. If you are looking to either maximize the amount you contribute, or you're in that scenario that I described a moment ago with the IRA, a solo 401k plan would allow you to deduct the first $19,500 of income. So in other words, if you earn $19,500, you can contribute $19,500. So you can get a pretty hefty contribution in with a stroke of a pen and practically no administration. If you're really trying to put aside a large amount of money, and it's a highly profitable business, then we may be looking more towards the idea of a defined benefit plan, because you can set up a defined benefit plan even with one person in the company, and then you could be looking at contributing much larger sums of money. One of the things I should mention as well, there are other types of pensions that I didn't mention here, some things like cash balance plans and so forth, that are also tools that can be used to contribute higher amounts of money. One of the things that's important to consider is the IRS gives us a great deal of latitude as a company to determine how we create the company contributions, or how we divvy them up, if you will. As I like to describe it, the government says you have to treat everybody equally, and then gives us about a dozen definitions of how to treat people equally. So you could define it being equal based upon the number of years they've been working with the company. You could define it based upon the number of years they have left for retirement. You could define it based upon their job title. So there's a lot of different ways that we can segment people so that we can get different levels of contributions to them. And obviously, as the employer, we're going to pick the one that's going to achieve the goals that you set out for yourself.
Excellent. And we have one last question, which I actually purposely saved for last because I think it's a good end note, although that's not to say if anybody thinks of a question while David's answering this one, we certainly have time for one more. If I know I'd like to start a plan for my business, what's the first step, David? Where do they start?
Okay, that is a good question. Let's finish with the start. Well, one of my favorite sayings is the best way to start is to start. So what that means is take that first step. If you decide you want to put aside money, and this is a good time of year to think about this because it's November 23rd, and we still have the opportunity to put aside money on a tax favored basis for 2021. What I would do is I would suggest that you reach out to the people who you use as the planning professionals in your organization. Many times it's going to be an investment manager, it could be an insurance agent, it could be your CPA, could be your banker, but speak to them about the idea that you want to put money aside on a tax favored basis for retirement, and let them coach you through which one of these plan designs is going to be right for you. Generally speaking, we don't have very many people who reach out to us and say, Dave, I want to set up a defined benefit plan. It's usually, Dave, I want to save money. How do I do it? Let that person guide you through these decisions and look to the different ways to save money. If you're a 1 or 2 person shop and you're doing things that you're looking for simplicity, you may reach out to one of the mutual fund companies, because a lot of them have some turnkey programs that may be of your liking. But pretty soon you're going to outgrow that, because you're going to want to look for different levels of complexity. Complexity sounds like a negative, but complexity is also how the employer ends up with bigger benefits than the employees, or how you favor the people who you're trying to retain, or whatever the goal might be. But to reach out to the fund company, reach out to your service providers and ask them to help you. And just, as I said, get started. To preserve your benefit, you do want to reach out to them for 2021. I would say as soon as possible. Some plans do require documents to be signed by December 31st, and time will go by very quickly. That's only about, well, it's less than 45 days away. And I can tell you this gets to be a very busy time of year for us to take care of that type of documentation. Plans that are set up before the end of the year do not have to be funded by the end of the year. So you may just have to sign paperwork, and then that paperwork preserves your right to put aside money on a tax deductible basis up until tax filing date. So there's lots of options available, but the way to get started is to get started.
Wonderful. Well, thank you so much, David. If you could just flip back to your contact information, so anybody who'd like to jot that down is able to do so. And thank you all for joining us this afternoon. We hope that you are all sliding into the long holiday weekend quite nicely. And we have recorded this presentation. It will be available on the firm's YouTube channel in about 24 hours. So if there's part of the presentation that you wanted to go back over, listen to again, share with a spouse or a partner, you'll be more than welcome to do that. And please also take a look at our presentation for next week, which will be presented by Justin Rice of Personal Wealth Strategies, all about student loans. Slay the student loans dragon, understanding the newest strategies to eliminate student loan debt. If you have anyone in your life who currently has student loans, or if you yourself have loans, I think that's going to be an incredibly interesting presentation. And we still have that registration link up as well. So thank you all. I'm sure that David would be happy if anybody has any offline questions for you to reach out to him directly. If you'd like to reach out to me and have me pass something on, I'm always happy to do so as well. And thank you all for your time today. Have a lovely afternoon, and thank you, David.
My pleasure. Thank you.